Well, hello and welcome to AGH Wealth Management's 2022 Market and Economic Outlook. We're pleased you're joining us and look forward to giving you our thoughts on the prospects for the rest of this year. My name is Brian Gensch. I'm a Senior Vice President here at AGH Wealth, and I oversee our private wealth investment strategies as well as our comprehensive wealth planning services that we offer here. And I'm joined today by our President, Brad Bechtel, who'll be bringing additional comments and perspectives along the way.
Hello, everyone. Thanks for joining us today. I do appreciate it.
So our agenda today is going to go over these 5 topics of discussion. We'll first talk through the economy and what we are anticipating there. We'll then talk about the stock market and some thoughts on last year, as well as the outlook for the rest of the year this year. And then we'll hit up bonds, talk through the relationship with this part of the market and our interest rate changes that are coming. And then that'll lead us right into talking about some of the most important people on the news today, the members of the Federal Open Market Committee and the Federal Reserve, and what the changes that they'll be making coming up this year. And then finally, we'll discuss the environment that we're in as it relates to the political arena and also, of course, the pandemic. So we'll first start with the economy. Looking at our economy, there are 3 major themes that we see being in the eye of the country, which are our economic growth path, our labor market, and then the I word that we are almost as annoyed with as the word pandemic or COVID. So we'll start with economic growth. So when it comes to our economic growth, we have had a good number of years seeing very little movement in the GDP for the US. Recessions have come in the last 20 years, and while we have had major movements in the market and the labor markets, GDP has been somewhat predictable as it reacts to the different economic cycles. And so when we think of the magnitude of 2020, we realize that what we went through was an uncontrollable shift in economic activity in this whiplash form that has caused a lot of our economic indicators to produce some extreme readings. You can almost think of this as a flashbang. And for a while, we were somewhat delirious and unaware of what was actually happening and how we would recover. However, we fast forward to today, and we have economic growth and GDP expected to be back in the range of 2.5% to 3.5%, depending on who you're reading. And this puts us somewhat back into a more normal type of environment as we transition out of the mess of 2020. And one area that obviously shows the unreal movement in 2020 was the jobs market. And we've talked about this in past webinars. We went into a period of job destruction overnight to now a tightness in the labor market that we really haven't seen in decades. With layoffs hitting 20-year lows and job openings surging, we can understand how wages have begun to provide some pressure to employers around the country. There's a heightened amount of people quitting as a sign that they're either moving to more gainful employment or they're job hopping as employers are forced to quote unquote buy employees from other companies. While this is a positive sign, this transition has happened at an enormous pace, and the labor shortage is being felt all across the industries, especially in hospitality, construction, travel, and transportation. Obviously, the pandemic is having an effect on this, and as we talk later about the big transition of moving out of the Omicron variant, we're hopeful that employers are able to find qualified employees to meet the pressing needs that still exist in the labor force. And we really don't have to explain, how we've seen inflation surge from the pandemic, especially here in the Midwest. You just go to the gas station and fill your truck up, and you'll feel that bite pretty quick. We all have felt the effects one way or another, and while some remember the inflation of the 80s, there are a lot of consumers today who are really experiencing this kind of cost increase for the very first time in their adult lives. So, what caused this inflation? Well, it was a mixture of actions and reactions that brought us to this point. For one, we shut down business temporarily, which halted production all around the world. Then we infused massive amounts of cash into the system for businesses and consumers to spend, not really knowing what the pandemic was going to bring. And then we opened it all back up and incentivized people to go spend it. And then you add in the mistiming on some supply chain disruptions. Think about the semiconductor chips, the extreme loss of truck drivers in US ports with 80 plus cargo ships sitting in the sea. And you've got yourself a supply demand relationship that shot up raw materials and labor prices. In our eyes, the transition into 2022 will be about the consumer's ability to absorb the higher costs that companies will be forced to pass on. And we do expect certain inflationary items like used car sales, home sales to dissipate, and supply chain issues will continue to clear, as we've seen, which will provide more relief to many companies. But at the end of the day, what we really have to care about is the increased in cost of raw materials and that getting pushed through the system. Can the end consumer take that and not completely have that cost drive people into bad financial situations?
Brian, being one of those old guys that lived through the 70s and 80s, and I was in college in the early 80s and remember the inflation numbers back then. And one thing about inflation that again, as you suggested, I think some people don't really realize is there is a self-driving force within it. And as you suggested, as producers, manufacturers and producers are driving prices higher to cover the cost of the supplies, the input supplies and input labor. The other side of that is and we're already beginning to see this, the more that consumers accept those prices, manufacturers and producers begin to realize that the price is elastic, and that not only can they raise their prices and consumers will accept it, but they can even raise it at a faster rate than their input costs are and collect it. And that creates a self-sustaining, self-generating inflationary cycle. One of the ways that inflation is obviously tamed is, as we'll talk about later, is what the FMLC does with interest rates, but it also has to do with consumers basically pushing back and saying, we're not going to accept those prices and we won't buy them. And that shuts down the demand side of that curve, which tends to recheck prices. So it'll be interesting to see how it all rolls out.
Yeah, well, and the other thing to keep in mind too is, with technology and innovation, and we've talked about this in the past as well. And in 2020, innovation was propelled forward, in 1 year, what probably would have been 5 or 6, maybe even in some cases, a decade of innovation changes happened in a short period of time. And what we've seen in the past is, a lot of the reasons you look at this inflation chart and you see a pretty muted inflation, even through the cash that we infused in the post 2008, 2009 Great Recession, is because, we've got technology innovation that's happened that has kept costs down. And so while other areas of, our businesses expense ledger have gone up in price, they've been able to reduce and offset that with technology innovation. And that allows wage inflation, which is a really important and a good thing to have sustainably over time go up. We want everyone to continue to increase their incomes, but we just can't do it at a pace that oversteps, being able to be a profitable business. And that's when you kind of roll into the into the layoffs and the kind of the beginnings of a recessionary environment. So no, I agree. I think it's important not only for consumers, for us to see how they will respond and continue in demand or not, and also then how businesses continue to innovate and keep driving parts of their cost of goods down. Yeah, good points. So we'll move on then to the stock market and want to touch on the uniqueness of last year, the pockets of the market that are not moving together, and then the volatility to expect this year. And I think we can all say we've already seen part of that happen. So going into 2021, last year it would have been easy to say that valuations were really high and higher than average at least, and it would be hard to overcome such a year like 2020, where we came off of a 18% S&P 500 return through the pandemic. However, probably the most impressive thing about the stock market was the earnings surprise that we saw. If you can believe it, earnings went up at a greater pace than the price of the stocks. Of the S&P 500, of the S&P 600, which is the mid caps, and even the small cap indices. And the ending result from this was that valuations actually dropped between 5 and 15% for the year, depending on your index. So companies created profits that were unexpected and of course welcomed. And so profit margins increased all through 2021, hitting all-time highs of close to 14%, which is a monstrous profit margin for the stock market to hold. And that kind of goes back to the inflation and that there's some wiggle room there that we can stomach some of this, and if profit margins come down, it could still come down to what's a reasonable profit margin long term in the stock market. And as we have inflationary pressures, then potential tax changes will begin to cut into those margins as well. We look for technology innovation, like I talked about, reduced pressure in supply chains to continue to allow companies to create these sizable margins and profits throughout the year.
Brian, I really like this slide because I do think that this is really that unknown piece, within the equity markets, and you go back. I mean, 2018 was the last time that we had a negative annual major market, large cap market loss within the equity side. The last 3 years, and I think if you didn't know what was kind of going on between, with corporate earnings going up, and I think if you just looked at the market and the economy, without the detail of what you just described, it is almost hard to imagine that we have had double-digit returns over the last 3 years, but it's really been the result of, as you said earlier, a significant amount of cash being injected into the economy, plus corporations outperforming even expectations, and so you tend to look at it and you think, gosh, how could the stock market not be overpriced? We've had double-digit returns for the last 3 years. Well, this slide really explains that. It shows that it's all about the E.
Yeah, and as I'm seeing our our graph, so I color coded the legend wrong, but the top line is the earnings, not the bottom line, and so that's where you can see the price to earnings ratio itself actually went down 5%, which is actually the orange line. And so yeah, what it doesn't mean is that we came into 2022 low valuation. I mean, we're still sitting at high valuations, especially with the impending interest rates coming. We consider them higher than what could be sustainable maybe through 5, 6, 7, 8 rate hikes. But yeah, as you can see, this is a great graph because it just shows you the relationship between your earnings and your price. And a lot of times as investors, we do just look at the price and we think, oh, okay, well, if it's hitting all-time highs, the common reaction to that is, well, then it should be going down soon. And the reality is the markets can stay elevated at a high valuation for quite some time. And so it's hopefully a graph that we'll change the color coding on the legend, but we will continue to have throughout our future webinars. So, while large stock indices had a good run in 2021, not all areas of the market allowed for increased earnings to keep prices higher. So if you look at like smaller cap growth stocks specifically, they were hit the hardest in 2021 with really no momentum as investors looked to a reopening economy to reallocate to and take profits from the small cap growth space. For practically the entire year, small cap growth stocks traded in a range. As the Fed's message became clearer about rate increases, growth stocks in general have had a hard time pricing in those hikes. And so many smaller companies carry considerable debt, 5 to 6 times EBITDA, which is earnings before taxes, interest, depreciation, and amortization. And since most of the debt is floating rate, increases to the federal funds rate directly impacts interest cost and can cut into profit margins. So what we believe there are good stocks in this space. We tend to favor ones that have a healthier balance sheet than the 5 to 6 times EBITDA in debt. So we like to invest in this space with companies that are more closer to 1 times EBITDA, and that if you have a solid historical earnings growth and then if there's pricing power in their respective industries, we believe that it's a good space to be. But the truth of the matter is, while the valuations went down as well because earnings did so well last year, they just traded range bound, and it was really again just due to the fact that call them out of favor or the theme wasn't particularly weighted towards their sector of the market. But we still believe that long-term, innovative, growth-oriented smaller companies that have that ability to continue to grow their companies into larger companies is a space that we don't want to be forgetting just because of 1 year. Additionally, value stocks have been set to have a tailwind as energy prices have recovered from their all-time lows. So financials have been favorable to investors as they priced in future rate increases, which positively impact their interest margins. And we don't believe growth stocks, again, should be counted out entirely of portfolios, as we have been through multiple economic cycles that have shown that growth stocks can grow in an environment where the Fed begins to raise rates. So one of the things is sure, market volatility will exist, and it sounds like I'm cheating because I already know it has. We're in late February recording this, but market volatility will exist in 22 past today with more magnitude than in 2021. If we strip out the pandemic seesaw effect and look back to 2019, besides the recovery from the March 2020 drop, markets have shown resilience against volatility, and investors have become kind of accustomed to quiet markets. The exception being COVID, from which we saw floods of cash coming into the economy, which provided a calming effect, even though the market prices were dropping pretty fast. So bracing for more volatility will be appropriate. You look back across the last 40 years, markets typically experience these intra-year declines that have averaged close to 14%. Market volatility does not discriminate between economic expansions or contractions. Markets will show high amounts of volatility in small amounts as it continues to grow through time. So this, we believe, is another transitory piece that investors need to be ready for. Emotional capacity is drained when markets drop sharply. And the more ready we are, the more we can make rational decisions through those periods of time. Because again, we really, 2018, we had some volatility in an economic expansion. Also, some of that related to things we're seeing today, wage inflation early on in 2018, Fed interest rate policy, directional messaging. in the fourth quarter of 2018. But then when we got to 2019, we were lowering rates, and then 2020, besides the 1 month, and then 2021, we just have had a really quiet market. And I think as an investor, it's really easy to kind of sit back and feel really comfortable about how every month it feels like I just can't lose money. And so when we all of a sudden get into a more normal environment where the markets do also go down and by substantial amounts, 14, 15%, and that's the whole market. I mean, you look at smaller cap stocks, they can go down much more on an ongoing basis in a normal environment. And so being ready for that is going to be important, because that is something that is different than the last 3 years. Again, we've titled this, "What's Not Transitory About This Year?" Because while we're not saying that because the Fed said stop saying transitory, there's a lot of things that we're transitioning in this year, and market volatility is going to be one of them.
Right. I think that your comment about emotional capacity is drained, when markets drop off sharply. I think that bears kind of repeating, because, even I think back to early 2020, as we were all learning what the heck COVID and even was, and as you suggested, markets were shutting down and we were all being sent home and et cetera, et cetera, et cetera. And I think about, a lot of the phone calls that I took from investors where we saw the market fall off from mid-February to mid-March by, nearly 30%. And we're all very excited. And again, we want to think logically about investments, but when it has to do with our own money, we think very emotionally. And I just think back to all of the phone calls that we had with investors during that period of time, trying to get them to pull back on that emotional drain to their capacity, and reminding them that, in virtually all of those cases, that, their time horizon for needing any of this money was, 10, 15, 20 years out. And, those that found a way to continue to keep a hold of their emotional, that drawdown that occurs, as you described, were aptly rewarded in that year. And it's always hard to say where you're going to end up at the end of every year. Obviously, your crystal ball is not any clearer than mine. Yeah. But continuing to recognize your time horizon and your physical capacity, because of your runway ahead of you, the length of your runway ahead of you to retirement, is really important, because your emotional piece is going to pull you back. And I think the volatility really causes that to amplify.
Yeah, I mean, it's a great point. As investors, why do you invest your money? You invest it so it goes up. So by and large, when the markets go up, we're not as appreciative emotionally, because that's what we expected. Alternatively, when the markets go down, it's actually doing the opposite of what it was intended to do. And that can create an overreaction negatively, emotionally. And then the market's just really mean enough that it likes to go down faster than it goes up. So you're always constantly, playing with that emotional psychology of investing in that, it's happening at a faster pace and it's going the opposite direction. And I fear it going down more than I enjoy it going up. And so those are just when you invest, those are some of the principles of investing, long-term, horizons and things like that are vital in order to stay away from making irrational decisions. And I will say, just from our experience in 2020, and I think I even maybe mentioned this in the past, but we saw a lot of resilience with a lot of our investors. And I don't think it's necessarily a pat on the back that we've done just this outstanding job of educating our clients, but I do think our clients, a lot of them remember 2008 and 9, and it really felt like back then, maybe the market's going to go to zero. And while, logically that doesn't actually make much sense, when you're down 50-something% over a year and a half period, it starts to make you think, well, where's the bottom of this? And so I think a lot of investors saw that and remembered, hey, I thought it was going to do it then, and then it proved me wrong then. So not to mention the joy of having cash just printed and thrown at us. I think that calming effect took place a lot quicker for a lot of our clients, and that remembrance of that. And so I just felt like we really had good client reaction to what was going on in a crazy moment in time when we really had nothing to be able to predict for the future. So, our broker dealers, LPL Financial, largest independent broker dealer in the nation, and in fact, we've in the past have used a lot of their webinar Outlook to use in our Outlooks. We actually this year we've come up with our own Outlook presentation now, which is fantastic. But they do have their own looks into the different parts of the market and what they're excited about, what they're maybe not as excited about. And so we thought it'd be appropriate still to show those pieces of information in our Outlook. And they put out a report each month showing kind of where they favor in the way of asset classes and sectors. And so in the stock market, they favor US stocks over financial or specifically financials and real estate. Now, this was before the Russia-Ukraine geopolitical issues that we've seen of late. And so they've been kind of divesting out of emerging markets from the standpoint of where they want exposure. So the U.S. stock still is to have a higher weighting in that space is they feel like appropriate. We do too. And then again, financials and real estate. Those are two. Real estate's a very good from an inflationary standpoint. I think what we would say is we got to be mindful of prices in real estate. So where in real estate you're investing is important, because we have seen kind of this large acceleration of value of, well, at least of price happening in that space. And then financials, they by and large they enjoy interest rates at higher levels than they are today because their net interest margins are better. That makes it more profitable. So, but again, where in financials are you going to be? Regional banks where more of their profits are based off of interest rates, or larger financial institutions where maybe they have investment banking arms and other arms that are may not have the same effect with interest rates. So by and large, value stocks tend to do better in this interest rate increasing environment, and they like financials and real estate. They do have a negative outlook on emerging markets, utilities and consumer staples. And then the consensus is still to have a diversified allocation. So to have large stocks, have small stocks, growth and value, along with having some in developed international companies. There are other developed countries out there that are coming out of the Omicron variant at different times, and their reopening of the economies are going to happen in a different period of time than ours has. And so there might be some opportunities to go grab some companies that have been hit hard prior to reopening. And so that's kind of where the stance is for February. So we're going to turn to bonds. This has been all but familiar to investors as we've watched 2021 become only the fourth time since 1976, and we're looking at the Bloomberg Aggregate Bond Index, and that's when it was created. So since the index for bonds was created, it's only the fourth time that returns have been negative. And so we're going to talk to the yield curve moves and the credit market as well. So last year we saw a negative return. So interest rates continued to rebound off of their lows, with the 10-year Treasury starting the year under 1%, ended the year a little over 1.5%. Now, this is still historically low for a 10-year Treasury. The over 50% increase, though, in rates in that year caused considerable pressure on bond prices. With interest rates already at practically zero, it's a hard environment for safe money to really make money with that kind of pressure. So while not every area of the bond market suffered, the safer parts that draws investors away from risky assets posted a disappointing outcome. There were riskier assets that produced a little bit better return, but if you were buying bonds for the safety and you're going to the safest part of that market, it was a pretty disappointing outcome. And we talked about this, I know, in the past as well. When the Fed started lowering rates in 2019 and then 2020 hit, and we had two outstanding years in the bond market, we looked forward and said, look, we think maybe the bond market just made as much as it could make over the next 5 years. And so last year we gave a little bit back. This year we're already giving a substantial amount back with the interest rate changes that have come, and so yeah, we're very mindful of that, and we just need to be aware though that bond investing is not always straight up either. And while we still may want to have bond investing due to the fact that they are still a good diversifier when the stock market has these large swings down, it's going to be a really challenging environment for us to do that in an environment where interest rates are increasing. So looking at 2022, we see headwinds, and we admit that it's one of the most consistent protections against stock markets, but we will have headwinds here, and we're not getting anything in safer assets like cash and CDs, except for the comfort of not seeing small negative returns happen when they do. So we tend to take a more active approach and making sure our strategies are employing the entirety of the bond market, as there are going to be dislocations that exist in this fixed income or this bond market allocation, and which can make money during interest rate hikes. Even though rates are going up, they can still produce positive returns over the long haul. But not a great time to be investing in bonds. And I think another challenging thing that happens with this is, for years we've had older generations who have been in kind of this ongoing interest rates coming down environment where bonds just have this tailwind for decades and decades. It's like, why would you invest in anything other than bonds? I can make 6, 7, 8% a year pretty easily, because I get the coupons plus these interest rates are continuing to come down, and that's a tailwind for my bond prices. And the reality is we're just in a way different environment. We have been for a decade, and we're just starting to see some of the issues that this can represent when we're in a low interest rate environment.
Brian, I agree with everything you said here. This is also kind of a good place to differentiate. There's individuals that actually buy the underlying bond itself, so the issuance itself, and then there's bond funds, and I think it's important for investors to realize those are not the same thing. Buying a bond and holding it to maturity will give you your principal back, with the exception of potential credit risks that you have with anybody that you're buying. But again, if it's treasury, it's generally backed by the full faith and credit of the U.S. government. So, but bond funds are generally actively traded, and so bond funds have a very different characteristic than buying the underlying bond itself. And I think bond funds, even particularly, are a tough time to be investing in bond funds right now, just because of that active nature of them buying and selling. We are seeing a lot of bond fund managers move their durations back in anticipation of future interest rate hikes. Because the further out they are, the harder it's going to get hit. But again, I think it's kind of important to a distinction between buying an underlying bond versus buying a bond fund.
Absolutely, yeah. It's a different, they're different mechanisms in how they look in your statement specifically, and what you can expect in the future, maturities versus just constant investment. Are important to know, and this is this is just 2021, the graph. I mean, we can talk about how today, we're running close to 2%. I mean, so we've already gone up in 2 months how much we went up all of last year.
Yeah.
And so again, we're just feeling that kind of pressure. And so as a result of the increased 10-year treasury amidst kind of a normal sluggish growing economy, is that the yield curve begins to steepen from the short end until Fed rates, but at the end of the day, it's kind of flattening, if you will. So while short-term rates will be beholden to the Federal Reserve, the longer-term rates have increased substantially in just 1 year, and the rate projections we read seem to land between 1.75 and 2% for the 10-year. And so, if we're sitting there now, then one of the things that we feel like is important to discuss is this an opportunity if you are sitting in cash to be in the bond market? Because if we've just priced in all these rate hikes and we've maybe overinflated the treasury yield curve too soon, our bonds trading at somewhat discounts for the rest of the year, knowing that the total return right now is less than I think it's negative 3.5%, depending on, and that's the good bond. That's the safer bonds that haven't been hurt as hard. So so while it's a continued risk of an inversion, that really will happen and be more important on how fast the Fed and how much they increase their rates when they start increasing them, as far as when the yield will invert. And the reason why we care about if this yield curve flips over and inverts is because that's one of the leading indicators that we've historically seen kind of lead to a recession in the next 12 to 15 months. And so that's something the Fed's very aware of, and they'll be monitoring as they start increasing rates. So for investors looking to tap into better income and less interest rate sensitivity, the other areas of the investable market include high yield bonds, bank loans, emerging market debts, mortgage-backed securities. Each of these carry other risks than safer bonds, but also create a better potential for total return in an expanding economy. When spreads are as low as they are now, it means that prices are elevated in the high yield market. So much like in the stock market, these higher valuations can exist for long periods of time, allowing investors to tap into better income and a good total return. The credit risk of default increases in these markets, and if a credit crisis occurs, some areas of these markets experience liquidity risks. But in an environment where credit risk is low, this can really be a place to help offset the interest rate pressures being felt in other parts of the portfolio. You just have to be mindful of the fact that this is a more volatile space, and so what you typically will see in your safer bond portfolio from a price movement, you need to expect higher movements in an area like high yield or bank loans if you get into these points in time where credit becomes a problem. Additionally, it's worth mentioning that the government did set up in 2020 multiple credit facilities through kind of the height of the pandemic. And while those are unfunded at this time, the structure's in place. And so government intervention could come to the aid of credit markets if economic conditions deteriorate and those liquidity risks are realized. Caution, though, is definitely encouraged when entering into this area because just because those credit facilities exist, it doesn't mean that you have, the government there to just save the day if we get into an issue in the high yield market. So you got to be aware of that too. So like the stock market, kind of show where LPL Financial has created kind of their negative, neutral, and positive views in the bond market. And so they show kind of a negative sentiment towards the high yield corporations due just really to their higher valuations, like that chart before showed with the tight spreads. Duration due to interest rates. So like Brad was saying, higher duration means that interest rate movements impact your portfolio more. And then foreign bonds, just kind of from the geopolitical risk that exists. Positive areas include mortgage-backed securities. And as always, they just encourage a core holding of high-quality bonds, whether it's corporate bonds that are high-grade companies, U.S. Treasuries, and they're kind of neutral on other less interest rate sensitive markets. Again, but consulting with an advisor is recommended, and no recommendation in these positionings is being made to anyone's specific investment strategy, but these are just the areas that LPL see for, they put it out in January, so technically for February timeframe. So moving to the Fed, Jerome Powell and the team have been getting used to the spotlight over the last 36 months as they've moved from stopping hiking rates in 2018, lowering rates in 2019, throwing in the towel in 2020, and then now recently creating an extremely aggressive stance on monetary policy for this year as they monitor the effects of inflation and the tight labor markets. So while the Fed has estimated on their own that 4 rate hikes is not out of the picture, just the fact that I created these slides maybe a few weeks ago means that potentially 5, and now we're hearing 6 and 7. So the Fed has not disappointed in changing and getting more and more aggressive along the way as they've continued to see what kind of inflation numbers come out. And last year or this last month, coming out at 7.5% year over year, a 0.6% month over month inflationary reading is a very high reading. And so they've gotten aggressive with their messaging as they've seen the data come in. And then the quantitative tightening process, which is the process of selling the bonds on their balance sheet. And this has been really the greatest culprit to the recent volatility that began in November and has really continued through this year, with the exception of the fact that the Russia-Ukraine news has caused somewhat of a stir as of late, but by and large, the reason we're seeing a bit of a correction in the market is because of exactly what this slide is entailing, which is where interest rates are going. And we expect the market to continue to have that uncertainty until we close in on those first rate hikes, with the first we expect being in March. And as of right now, the Fed's pricing the market's pricing in a 0.5% increase for the first one. But again, it's yet to be seen until they actually do it.
Brian, I think the Federal Reserve is probably one of the more little understood contributors to the market, within our economy, and yet there's such a large component of what happens. Rather, it's an expansionary or contractionary positions that they take with the interest rates, and as we've seen them with the quantitative easing and the bond buying. I'm reminded though of some old axioms that I was taught years and years ago. One being, don't fight the Fed. And that thought there is usually don't assume that your companies are going to be able to outdo and overperform what the Fed's trying to do. If they're trying to raise rates and bring inflation down, the Fed typically wins those contests. I think the other thing that's always interesting when you deal with the Fed, there's an old saying again that when the Fed chair sneezes, the market catches a cold, meaning that just slight things, slight changes, slight modifications, even the vocabulary of the Fed chair. There are people out there that Literally, when the Fed does their written analysis and public statement, people will sit down and count the number of positives versus negative words within the public statement to determine if they think that the Fed believes the market's going to go up or down. It's literally analyzed to that extent. The one thing that, as I look at, end of last year and I look at where we're at right now, I'm struck by the feeling that I just feel like the Fed has gotten behind. The Fed first had to talk about the fact that they were going to talk about interest rate hikes, and after they had talked about the fact that they were going to talk about, they finally then started talking about it. And after they talked about it for a while, they started getting to the point where they might actually do something. And all the while, as you stated earlier, inflation has really spiked, and now we're in this environment where, as you stated, the expectation is for a 50 basis point increase in the Fed rate, in March, and likely a quarter basis point in each of the following months that they meet after that. The consensus within, really, if you go back, you look at Goldman, JP Morgan, Morgan Stanley, UBS, Citibank, all of those, it's anywhere from 6 to 7, hikes that they anticipate just in 2022. The difference between the 6 versus the 7 is the 6 are anticipating a 50 basis point jump in the first one, followed by 6 at a quarter, whereas the 7 are, 7 different quarter 25 basis point increases. So it'll be an interesting ride to see where it's going to go. But I've always said the whole point of the Federal Reserve is they are the brakes of the economy. And when the economy begins to overheat, inflation, production, et cetera, and the markets can't sustain it, which is really where we're at right now when you look at labor markets and shortages and all of the things that were happening. This is that classic, that college classic textbook example of where the Fed starts tapping on the brakes and slowing the economy down by increasing costs, lending costs. So I think this is a very important slide, and one that probably at the end of this year and into next year we'll be talking a lot about, and what was the effect of those changes that they made.
Yeah, it's hard to, so you're referring to, I think, what's called the Fed Beige Book, right, where they measure their positive and negative words.
Right.
At the same time, you get a Powell come out and say, we're going to be, I always said, humble and nimble, and no one knows what that means.
Yeah.
So, so not only is it hard to figure out what's he saying positive and negative, but then we can't even understand what he means when he says, how they're going to transact monetary policy this year. And so, what I think that means is that, hey, if inflation dies off, we're not going to do what we said we're going to do. And so we are taking the stance that the inflation we're seeing today is not a sustainable inflation long term that will happen for the next 2-3 years. But there might be 9 months of seeing high numbers, and as that come down, the question is, will the Fed have overcorrected too high? Because I agree, they started too late, and I think the Fed has been pretty consistent with being a little late to the game, whether it's raising rates or lowering rates. They've just seemed to be somewhat, besides the pandemic when we all were making the decision to go into a recession, they were on the ball there, but they tend to drag, and that's because their dual mandate is, the jobs market and inflation, and so the first thing they had to take care of was making sure that the job market was not loose, and it is very tight right now, and I think they did kind of delay too long for that, and so this is going to be some catch-up rate hikes that are happening, because it's being at a low interest rate, zero interest rate environment is not actually a healthy thing for our economy long term, or the markets long term. And so, the volatility we're seeing today from the stock market due to these rate hike promises, really they're only hiking them because we're in a great spot economically. We're in an economic expansion. We are, but all 12, 13 indicators, besides wage inflation, are signaling that we're in a good middle market or middle cycle economy. And that's a good place to be and to invest in. And so, we talk about when the markets are dropping, or the volatility is picking up and it's going up and down and up and down. Your two environments from an asset management standpoint are these buy the dip moments or sell the rally moments. And we would tend to lean towards, these are probably more of the buy the dip type of moments right now than sell the rally. And there's a lot of other things going on into that, but the Fed is a big piece of it. And we're going to see that play out over time as they continue to try to telegraph what they're doing, and then do what they say they're going to do. All right, so wrapping up all of this, that transitions really the experience that we're seeing from the Fed. Again, the transition for the Fed this year. So transitory is the word of the year, albeit no one wants to say that. It makes sense to also show there are some other variables that are going to scream for our attention this year. And so we wanted to talk through those as well. So it seems like we felt the effect of the pandemic land all too long, and our hopes of being out of the storm continued to get disappointed as all these other variants like the Delta and the Omicron variant come. And they've kept this virus kind of alive and well while we've been, trying to get through our medical advancements to create, better vaccines and immunotherapies and other things that can assist in this kind of virus that is going to be around for a long time. Omicron specifically created the highest case count we have seen since the beginning of the pandemic. The silver lining is that many people have taken precautions to protect themselves, and the variant has proven less intense than the other variants. Vaccines, therapies, and access to medical treatments have increased at historic rates, allowing for our frontline healthcare workers to have the tools they need to continue to help those infected. As case counts have dropped significantly this year, we anticipate that COVID-related deaths will also begin to decrease, allowing for more reopening effects to trickle through the economy. While we're not naive enough to think that we won't see another variant, the new normal of living with COVID will allow many areas of the market to continue to practice regular business practices that they used to be accustomed to prior to all this starting. And again, we say new normal, again, one of those words we don't really like to hear anymore, but we have to understand how we will live with COVID. And from a market standpoint, that's going to be important to define going forward so that we have more predictability and clarity about how the markets will be affected by the next variant. And that's important because the market always likes clarity over uncertainty. And so this is just one area of hopeful clarity that we can get this year that could create some calm. And we've seen the markets really, the COVID data has not been market movement stuff this year. And that's just, again, because of inflation being such a big piece of what's going on. But it's looking good. We're a month and a half, 2 months in. So we're not predicting anything at this point in time. But we are saying that, the Omicron variant has really run its course by and large. And I know I talked to healthcare providers and people who are clients and working in the hospitals and frontline workers, and it wasn't but 2, 3, 4 weeks ago, it was a risk to get in a car wreck because the hospital beds were full based on either COVID patients or not having enough staff. And those numbers are starting to go away, and hospitals are returning to a more normal flow. And that's just a good thing for everyone, not just for COVID-related health issues. And so we think that should continue. Variants will happen, and as we take those variants on, the hope is that our medical advancements can help us kind of maintain a more normal business practice and not have to have so much intervention that can mess with economic data and market data. So one of the advantages of getting back to normal is also the return of efficiency in the supply chain. And whether it's exports or import woes, freight issues getting hands on inventory and parts, these supply chain constraints have continued to relax. And that's maybe one of the most positive transitions we may experience this year. An interesting note on the supply chain effect of the pandemic was how deliveries surged in 2020. So as people were forced to stay home and purchase things online, and as consumers received a lot of cash to cover those purchases, we saw a dislocation of supply deliveries as it relates to the overall manufacturing index. We expect deliveries to continue to come down as people return to in-store purchasing, and so we'll not be surprised if the entire index moves down into the lower to mid 50s. And as a reminder, the ISM index measures whether or not our economy is expanding or if it's contracting. And a reading under that 50 mark, that line says that we are in contraction, and a reading above that would say that we're in an expansion environment economically. And so again, we had a dislocation happen in 2020, and much like the flashbang maybe scenario I mentioned at the beginning, there was kind of a delusionary effect to this, and from a supply chain standpoint, and that's going to continue to hopefully get resolved. I know there's way less ships sitting in the sea waiting to port to get onto a port than there were even a month ago. And so we know some of that is already starting to work its way through the system.
Brian, I think this slide, I agree with you. I think we'll start getting ourselves back to normal. I think about, we've all seen the signs of CDL drivers wanted. There's a roughly an 80,000 driver shortage right now, and the good news is I think I saw somewhere where it takes like 30 to 60 days to go through your CDL training, and obviously wage rates are going up there for CDL drivers. You drive around town, you see help wanted and drivers wanted and bonuses being given out. So I do think we'll see more drivers go into that particular area. But I think, as we talked earlier, as the Federal Reserve starts to raise interest rates, I think consumer spending might slow down a little bit. Obviously, consumer balance sheets right now are pretty attractive just because they got that big influx of cash, and obviously some people didn't have jobs, so that didn't work out for them, and they do have debt on their books, but those that were able to maintain their jobs and had that opportunity, they did get the stimulus money. They continued to buy things. I think I saw the number one thing that was bought during the pandemic was like giant screen TVs. So, again, that, kind of shows that demand that was created, which then, as you said earlier, sparked the shortage. And I think a lot of people tend to think we've just had this supply side shortage, but it was really the genesis of that supply side was the demand side that spiked it, and then we weren't ready for it, so because we shut down our factories.
Yeah, and I know we talk a lot about, and we hear a lot in the news about our chip manufacturing, and there's going to be some growing pains with figuring out how do we move away from relying on a Taiwan who could be invaded by China at any point in time for our chip manufacturing, and how can we do it cost effectively though in-house, and so that there are bigger issues happening in the supply chain. I don't want it to sound like, oh, it's all is going to be easily fixed soon and nothing to worry about. There are still things going on in the supply chain arena that are things that we need to be mindful of, but like you said, it's the return to normal is evident. So if all those things weren't enough to have transitionary periods defined for 2022, we get to do all this transitory stuff inside of a midterm election year. So historically, since the 80s, the stock market has had higher bouts of volatility in the midterm election years. And while we can't solely blame the political leaders for their noisiness they caused during this time, we do believe there's meat to this statistic. In fact, our current year has already started to feel a bit like the average midterm year shown in this graph. And now we are not promoting the idea to sell all your stock in April or May and buy back in droves in November. But it's a good reminder that when political leaders campaign, outlandish promises are made, markets tend to react from the uncertainty, and then calmness floods in once the certainty comes, regardless of the colors of the branches of government. And another interesting historical stat is that the House of Representatives has often flipped parties in the midterms. So the current House has already kind of shown signs of a pendulum swing taking place. Biden's approval rating is extremely low right now due to his failure to get the BBB plan passed. And that's just a statistical comment. And so it wouldn't be unexpected to see that branch of our government turn red. What does that mean for the markets? Well, the main effect would be that we'd see some even more gridlock in Washington than we already see. And the markets historically actually like gridlock because it creates that added checks and balances, and that can create a really more favorable growth experience moving forward. So strap in, and again, I think we're just going to have to get used to the fact that volatility. There's a lot of reasons that we should see the volatility happen this year. It doesn't mean that the markets will be negative for the year. It doesn't not mean that, but it doesn't mean that volatility doesn't just immediately produce a full year negative return. If anything, it could create more opportunities. So again, while Jerome Powell has said that the word transitory is out, we beg to differ. We believe there are many things going on in this economy and the markets that are transitory by nature. Transitions can be healthy in many ways. And while we didn't cover in detail every one of the bullet points on this slide, we do believe that all of these transition points can create uncertainty, and that's why we don't get surprised when the markets start to sway. So how do you respond? Maintain a cool head in hot waters. Take the Buffett approach and put some cash to work when volatility hits. His comment: be greedy when others are fearful, and fearful when others are greedy. Invest when there's blood in the streets. These are kind of age-old principles that can enhance your long-term wealth path. However, you need to be aware of your risk appetite. If you can't handle taking on the risk in volatile markets, then create a plan to reduce that risk exposure over time. Talk with your financial advisor if need be, but have a plan and stick to it. And also consider that plans need for growth despite your risk appetite. There's kind of a marriage we have between an appetite for risk and a capacity for risk that's healthy if it's done right. And what I mean by that is investors have an appetite for risk, but their wealth path, their plan to hit their financial goals, have a capacity of risk that needs to be taken. And those aren't always equal each other. And so having a plan and understanding your risk appetite will help you find what's an appropriate amount of risk taking in your investment strategies that complements both of those. And again, as always, if you have any questions, we're here to help. We're ready to assist as you're able.
Brian, I would agree with your comments there on appetite, for risk. I think one of the things that I have historically seen as I'm looking back over my career, and now I've lost track of the number of down market cycles that I've seen. But one thing that seems to be somewhat universal that I see every time there's a cycle of down market, and that is that investors, when the market's going up, get overconfident and tend to underestimate their appetite, or overestimate their appetite for risk. it's almost like, it's that, close my eyes and I can throw a dart at the board and I hit something that's going to go up. And all of a sudden the market then starts to go down, and it's not uncommon for us to, as we're working with investors, for them to begin to communicate that they might have been overly aggressive in their appetite for risk. And I think that's where it goes back to, as you described, the capacity for risk, or that again, that time frame of when are you going to need or be using these dollars that you're investing. And again, I would suggest that now's a good time to evaluate the capacity, of for your risk as well as your appetite, because again, with the markets kind of changing directions right now, oftentimes that from an interpersonal or emotional standpoint, that degree changes. So
Yep, no, good words. Yeah, so thanks for everyone who's listened or watched this presentation. If you would like to know more about anything we said or have questions about what you should be doing, don't hesitate to call myself or Brad. We'd be happy to have that discussion with you. Otherwise, we hope that this has been helpful, and we look forward to returning with our mid-year outlook sometime in the late summer. Again, thanks and stay safe, and we appreciate your time.
thank you very much.